Okay, Chapter 1, Role of Managerial Finance. And this is our learning goals. We're going to talk about finance and the managerial finance function, the legal forms of business, which I'm sure you know already, and the goal of, we're going to describe and explain the goal of companies. And the goal of companies is to maximize profits, maximize the value of the firm for shareholders. So whenever a company makes anything, any product of any sort, they're maximizing profits. And this is something that may confuse a lot of you, and this is one good thing that the simulation drives home pretty succinctly, is that when a company makes a product, they're not making the best product for you at the lowest price so they lose money. They're making the best product for the company to sell to you that may meet your expectations, may not meet your expectations, but they're making a product that they could sell at a profit. And that's the goal of the company. Apple can sell iPhones for half the cost, but they sell them their iPhones and their MacBooks at an extreme premium, and that's how their profit margins, and they have, I don't know, $100 to $500 billion in cash, because they sell their products not at the lowest price possible, but at the highest price possible to make a maximum profit for Apple. They can do this because their products are generally awesome and they're worth it. But many other companies, when they're trying to make products for you, they don't make, and this is a mistake a lot of people do in a simulation, they try to beat all the customer expectations and create a low price. That will put your company in ruin. What you have to do, and what companies do, is they make the best product possible for the company to maximize the company's value. And hopefully, it works for you as well. And that's why, if you take food, for example, packages of food. Anybody here over 30? Anybody over 30? Okay, one. Okay. Do you remember what Oreos and Chips Ahoy used to look like? They used to be huge, twice the size they are today. Cereal boxes used to be pretty, now they're like this, same facing size, but they're much smaller. Peanut butter is all dimpled in and pushed up at the bottom, so it looks like the same size, but you're getting 4 ounces less. Same thing with chips, yogurt, ice cream. They don't sell Haagen-Dazs in a pint anymore. Do you realize it? That's why Ben & Jerry's says still a pint on it, because they realize that manufacturers have been making products smaller to maintain the same price. So when you go to the store, you're paying the same price, but you don't realize they took a few ounces out, or a few garbage bags out, or for a few sheets of paper towels, because they're trying to maximize their profits, but they're not really want to advertise to you that they're giving you less. And that's one way to do it, is to give you less, but charge you the same money, and call it new. Sometimes they call it new, renewed, or new and improved, which just means it's a smaller size at the same price. And if you look at car companies like a Volkswagen, instead of really giving you a car that was clean diesel, they gave you a car that was dirty diesel, but made it so it could pass the test so it seemed like clean diesel. Because that could maximize their profits. They could charge much more for a clean diesel car than a dirty diesel car, which they couldn't even sell. So companies, they don't always have your best interests at heart when they make a product that they want you to buy. They have the company's best interests. And you'll see that in the simulation. The winners of the simulation are the ones who make the products in the best interest of maximizing the simulation company's wealth, not give a consumer the best possible product exceeding all your expectations at a low price. No one does that. But why you think they do, because all the marketing, they send all the marketing out, and they get you to believe through marketing that you're getting the best product at the lowest price. It's all marketing. And we'll give you more examples of that as the class goes on. Describe how the managerial finance function is related to economics and accounting. The primary activities of financial manager. Describe the nature of the principal-agent relationship. So these are all our learning goals. So let's start with, what is finance? Or I like to say, WTF. What the finance? And, it's basically art of managing money. It's the art of creating wealth. So finance is, I think of it as an art as well as a science. It uses a lot of mathematical principles in finance as well. In fact, if you go for a PhD in finance, it's pretty much all math. So there's a great deal of quantitative as well as qualitative type of elements in finance. But basically, at a personal level, you're concerned with finance at a personal level. You're concerned with, how much money you make, your earnings, how much you save, and where you invest your savings. So at a personal level, you're thinking about your budget, what you can buy, managing and affording your life. In the business context, we're looking at raising funds from investors who want to invest in your business or your idea. How to invest that money to earn a profit. How firms decide whether to reinvest profits or redistribute them back to investors. So those are some big contextual issues inside of finance. But basically, we're looking for ways to maximize the wealth of companies and firms. And we want to figure out what's the best way to make money for our company so our investors profit. Pure capitalism. Okay, so let's talk about some career opportunities if you want to work in finance. There's financial services in this area of finance concerned with delivering financial products to individuals, businesses, and governments. Such as financial products can be pretty much anything from a bank account to a stock, an IPO. And there are career opportunities in banking, personal financial planning, investments, real estate, and insurance. So banking, you can think of banking in two sort of categories. You have your commercial banks, or your personal banks, or your credit unions, and that's really, making small auto loans and small business loans and mortgage loans and managing maybe some money markets just in a bank setting. It could be as low level as being a teller or being someone selling accounts at the bank. But there's also investment banking. Investment banking is more about helping businesses make financial decisions as far as expanding mergers and acquisitions, IPOs, things of that nature. Personal financial planning is helping other people who don't know anything about finance and helping them to manage their budgets, manage their money, save for retirement, pay for their child's education. Hopefully your parents had a financial planner that gave them good advice that helped you save money for your education so you could attend that $100,000 school. Oh wait, you're at Stony Brook. Well, this still costs a lot of money. It's not, you think, well, that was never mind. Trying to distract me there. You think that a public state school would be cheaper? It's still quite expensive, and the tuition's going up. All going up. The rate of increase of inflation of tuition is, I think, 14% year over year since 1987. So that you need a financial planner to help finance that now. And real estate, there are people who work mostly in mortgages and real estate, and insurance companies hire a lot of financial people. Insurance companies are more than auto insurance or home insurance. There's a lot of behind-the-scenes financial work at insurance companies that hire a lot of financial professionals. Now, managerial finance, that's where I worked. I was in the managerial finance, which worked in a company in a corporate finance. So I worked for companies in finance departments to help make them wealthy. So financial managers' duties are varied depending on the size of the company. The smaller the company, the more duties you take on. The bigger the companies, the many different roles that you can assume, and you have a more finite type of job responsibilities. But you're still concerned with making the business work as efficiently as possible. So you have to administer the affairs of the financial affairs of the company, which that could mean developing a financial plan, a financial strategy, a budget, figuring out how to extend credit to customers and setting credit terms, evaluating large expenditures, buying big pieces of equipment, raising funds to finance the firm's operations or expansions. So it's a lot of work to figure out what's the right move, who should we borrow money from, how should we invest it, when should we expand, what company should we take over, merge with, who should we lend money to, what are the credit terms, how should we get paid back. These are all concerns financial managers deal with in running a company. Okay, so we had this global financial crisis that changed the landscape of finance somewhat because of this great recession we had. We have more than ever companies are dealing with global competition, rapid technology changes, rapid regulations changing due to the Great Recession. A lot of financial regulations have changed. The complexity of the financial manager is pretty vast as far as what they have to learn, the re-education, and that's why accounting is pretty stable. You have your accounting, you have your GAAP, your FASB, and you have your pretty much balance sheet hasn't changed in 100 years. Income statement. Accounting is pretty much accounting. Once you learn it, you're good. Not too many changes occur. Some changes, but But finance is changing all the time. New financial products, new regulations, new technologies, just in your lifetime. Think about all the new ways to buy and pay for something. You take your iPhone, put that little, what's that square device you put on to bring your charge card through your iPhone? Yeah, Square, that's it. You have Apple Pay, you have Android Pay, you have stick the card in the slot now, the chip, or you have the swipe the card, you have pay online, you have PayPal. I mean, these are all financial innovations that if you're a company, you need to accept all these payment terms. You have Bitcoin is another new currency that a lot of companies are accepting now. Anyone know how Bitcoin works? I do. It's pretty confusing. You do? Good. Well, you have to have a pretty strong computer set up to mine Bitcoins at this point. Mostly the Chinese do that right now. But and Bitcoin's a very volatile market. But it's a currency that is free of any governmental interference. A lot of businesses have been trying to accept Bitcoins and figuring out how can we make ATMs for Bitcoins and credit cards for Bitcoins and transfer funds through apps and things like that. Okay, so let's talk about professional certifications in finance. Now, if you want to make the big money in accounting or finance, you need to be a CFA or a CPA. So anybody here going to be an accounting major? Okay. Could be a very lucrative position if you like accounting. That's the first priority. Make sure you like it. Some people do. It just wasn't me. I do me, and it's not accounting. And two, treat yourself to a career you like. Two, make sure you get a CPA, because those are the people that, you start at 100,000. In finance, we have an even harder test called a CFA, Chartered Financial Analyst. And from the accountants I've talked to who also have both the CPA and the CFA, they said the CFA was harder, and the CFA has a lower pass rate, where the CPA has a higher pass rate, maybe 50% or greater. The CFA has a lower pass rate. But this is sort of a Chartered Financial Analyst is someone who goes through these 3 levels of testing that focus is mostly on the investment side of finance, but these 3 levels of testing, then you get this Chartered Financial Analyst, and boom, you're definitely making over 100,000 to start anywhere. Is anybody here an AMS student who would do actuary? Okay, so there's an actuary exam. That's another great way to get into the 6 digits pretty quickly. Once you finish and take those exams. So having these credentials, because a college degree now is like a high school degree when I graduated. When I graduated high school, I went to college, and when I got a job, I was working with a lot of people who just had high school degrees. And then that changed, and now you don't get a job unless you have a college degree. But that's just like entry level. So to get to the next level, you either need a graduate degree or one of these certifications. So if you're in accounting, you want a CFA. If you're in accounting, you want a CPA. If you're in finance, you want a CFA. And if you're in math, you want an actuary, pass the actuary exam. But there's also certified treasury professional, which is another good one, not as strong as a CFA. And also certified financial planner. For those of you who don't want that big of a challenge, you could do that one. It's not too hard. But it's still pretty lucrative, and if you're someone who likes to work with people and help people meet their financial goals, that can give you a wide range of topics and possibilities. But again, as a certified financial planner, you're generally building your own business. And it takes longer to create that wealthy position where you're making a lot of money because you have to get your clients. So it's a longer road, and it's not for everybody. But these are just different credentials you can get to help establish you to get a better paying position once you graduate. There's also American Academy of Financial Management and certified professional certifications in accounting like the CPA, the CMA, and the CIA. So those are in the accounting. So if you don't want the CPA in accounting, there's also the CMA and the CIA. They're not as good. The CPA is the best, the CFA is the best. But hey, they're all resume builders, right? So whatever you can get it. Okay, let's move into legal forms of business. We have, I'm going to go through this quick because this is covered like in every class. Sole proprietorship, easy. I want to be a sole proprietor, done. You work by yourself, minimal paperwork to fill out. You run a business, you keep all the profits. Partnership, it's like your teamwork in a simulation. You find some people who want to work with you, and you get together and you form a partnership. Corporation, you create a legal entity that's an artificial person that has many advantages that we're going to go over right now. I know you can't see this, but it is in your textbook. It's table 1.1 in the textbook, but I'm going to use this. This is mainly for me, just to give you the strengths and weaknesses. I apologize for the small size. Okay. Sole proprietorship, the benefit is you get to work by yourself. No one, you don't have to cooperate with anybody. The downside of this is that it's hard to raise funds as a single person. You have unlimited liability. If someone hurts themselves on your product or your store, they can go after your personal assets as well as your business assets. And this business dies when you die. Okay, not to be morbid. Now, a partnership is a little bit better because you're working with additional people. They can bring more funds, and the ability to raise money is a lot easier. You have more brain power, more managerial skill. So the partners can help you to do better because you're going to expert in each of the areas that you really need to make your business strive. But again, this has unlimited liability as well. If somebody gets hurt, you're going to, you and your partners are going to have to be subject not only to your business being sued, but also going after your personal assets. And it's difficult to liquidate or transfer partnership to somebody else. So sort of like a marriage. Partnership is like a financial marriage. If you go into business with somebody as a partner, they're married to you now, financially. And sometimes it could be just as tough as being married. Is anybody here married? Nobody's married? No? Okay. Divorce? So you were once married. You know how tough it is. Anybody here dating someone annoying?
That's what I love, tequila.
Anybody here dating someone who's annoying? Or you don't? Someone like you're just not sure you're going to be dating them much longer. You can't say maybe because they're in the class. You don't want to break up now because you have concert tickets, or you have travel plans. You're going to wait till after that, or your birthday's coming up and you think you're getting a nice present, and then you break up after that. But it's kind of like that's like a partnership, I hear now that for you guys it's Netflix and chill, but for me it's Netflix and fall asleep in front of the TV. Okay, corporation. This is the best for last. A corporation is awesome. You have limited liability. They can only get your assets that you have in the corporation. So your ownership in the corporation is the only thing at risk. If someone sues you, they can't go after your personal assets. So you have limited liability, limited only to your investment in the corporation, which protects your personal assets. This could be, it's easy to sell ownership in a corporation to bring in more people and more investors by issuing stock. And it's ownership is readily transferable. You can get in and out of the corporation pretty easily. It lasts forever. It's an artificial person, so it never dies. A corporation can last forever. And you can hire professional managers to run the business for you. The downside is tax. There's double taxation in the corporation. So you get taxed. The corporation gets taxed on their money, and then when they pay dividends to investors, they pay tax and dividends. So that's the big downside, is double taxation. That's why a lot of corporations put their money in the Cayman Islands or in Ireland, like Apple does, or they hide it overseas. They don't have to pay that double taxation on it. It's more expensive to set up legally, to get the law fees and the paperwork and the accounting regulations. It's just more expensive to set up and maintain. And it's subject to more government regulation, and it lacks secrecy. Everything is much more transparent in a corporation. Okay. So, but if we look at the amount of businesses, the total amount of, and this is in the, I believe this is in the millions here. We got 23 million sole proprietorships, 3 million partnerships, and 7 million corporations. But these 7 million corporations make up 80% of all the sales in businesses. While sole proprietorships do 2%, and partnerships do 7%. So think of sole proprietorships like the liquor store, the laundromat, the card store, and think of corporations like Coke, McDonald's, Disney. Anybody see the new Star Wars film?
Yeah.
That was good, right? You want to know the secret of the film? No, I won't tell. I didn't like that Kylo Ren guy, though. You need a teacher. Yes, they're hilarious. I don't know. I just picture that guy from Girls, and I can't take him seriously. Okay. This is the organization. I'm going to teach you this, talk to this side of the room. Are you texting me again? What do you say about that? I'm just kidding. She's not texting me. Were you texting at all? No? All right. She's very shy. Don't talk to her. All right. So here are the stockholders at the top. They own the company, and they elect a board of directors. So the stockholders own the company, and they elect a group of people to manage the company. It's like, okay, I own this thing, but I don't want to deal with it, so I hire a board of directors, and then the board of directors hires a president. Twitter has a new president. Oh, I have to be closer to the microphone. Sorry. Twitter has a new president. Did you hear about this? They weren't doing good because you guys stopped tweeting. You know, I have 20 followers on Twitter. I think that's pretty good for me. So we have the president. The president then hires his vice presidents. So we got the vice president of human resources, manufacturing, finance, marketing, and information technology. The CFO, chief financial officer, which is also known as vice president of finance, he then hires a treasurer and a controller. A treasurer deals with the money. And the treasurer will hire a credit manager, a foreign exchange manager, a capital expenditure manager, and then also possibly a cash manager, pension fund manager, and financial planning and fundraising manager. So they deal with the money. Treasury deals with the money, the treasury officer, money. The controller is someone's going to deal with more of the accounting side, and they're going to hire a tax manager, a cost accounting manager. I did like, when I did cost accounting, that's the one part of accounting I liked. I did like that. It was fun. Corporate financial manager and a financial managing accounting manager. So this is for a bigger business. So the organization, there's a lot of top roles for finance professionals in a corporation. So the corporation, you know, it's not Wall Street that hires the most finance people, it's corporations. So most of the people who work in finance work inside of corporations and businesses, big businesses. All right. Okay. Some career opportunities in managerial finance. Of course, there's the financial analyst. And the financial analyst is someone who analyzes financial plans and budgets and financial strategies, forecasting, performance, financial comparisons. This is what you're going to be doing in the simulation. In the simulation, you're basically going to be financial analysts, and you're going to be trying to analyze the inputs of this company to maximize profits. You have a capital manager. This is a person who is going to look at investments in the company and figure out what's the best use of capital. Capital is another word for money. Cash manager. This is someone who's going to maintain the daily cash balances of the corporation. It's sort of like, in every family, there's someone who is managing the cash. Maybe it's mom, maybe it's dad, maybe it's you. And it's the person who basically says, okay, these are the bills we got to pay, this is the money we're taking in, and these are the investments we got to make. That's sort of the cash manager has to make sure there's enough cash in the engine. Think of a business like an engine, and oil is the cash. If you don't have enough oil in the engine, it seizes. If you have too much oil in the engine, I don't know what's going to happen, but it's not good. So you have a credit analyst, a manager. This is someone who looks at figuring out who we lent money to, what the terms should be, how we should collect that money. Because not everybody deserves to be lent money. Because some people just won't pay you back. You've all had that friend, or maybe it's you, that you lend them money, they act like it never happened.
I go to Atlantic City.
Oh, my friend Mohican Sun.
Yeah.
It's closer.
All right. Never win there.
Play craps at all?
Huh?
You play craps at all? No. Okay.
Very crappy playing.
Pension fund manager. There's not that many of those anymore. And a foreign exchange manager. And that's for large companies that deal with a lot of foreign exchange money, the changing rates. And right now the dollar is strengthening, making it a challenge for a lot of foreign exchange managers, because if the dollar strengthens, it makes your products more expensive when you export them. But when you import, the raw materials get cheaper, which is good. One of the reasons gas prices going down because of the strengthening dollar, but it's difficult for manufacturers to sell abroad because their products get more expensive. So this is something a foreign exchange manager can mitigate a little bit by hedging some of their positions in foreign currencies to make up for these losses. But these are just different jobs. Okay, so how do we maximize wealth? You got the financial manager, and he's going to make financial decisions or think of alternative courses of action, assess the risk and return. Is this going to increase the share price of the company? The decisions, just like when you use a simulation, you got to think, are these decisions going to increase the share price of the company? And let me tell you right now, this is how you increase the share price of the company. You increase profits, you increase earnings per share, that increases the share price. If the answer is yes, you accept the proposal. You make the decision. If it's no, you don't do it. Okay. So which investment is preferred? If we have two investments here, there's a little test here. The goal is to maximize profits. Which investment is preferred? We have Rotor and Valve. So year one, these are earnings per share. In Rotor, we get $1.40, $1.40 in year three, which is a total of $2.80 for the 3 years. And in Valve, we get 60 cents, $1, and then $1.40 for a total of $3. So which company is a better investment? You don't have to answer, just think about it. Just keep the answer to yourself in your head, right? Okay, so one thing that's very important is timing. So if we're going to make a decision here, we want a decision to maximize profits, but profit maximization may not lead to the highest possible share price for the company. So sometimes getting more money up front will lead to a better share price. So if you're thinking short term in their first year, I'm going to get more money here than here, so this would be a better investment year one because I'm getting the money sooner than later. And because the time value money, the money you get later is worth less than the money you get today. All right, so that's a consideration. And profits do not necessarily result in cash flow to shareholders. So profits doesn't mean cash in your pocket. Oh, I have a note. No cash. Took it for lunch. Okay. I have no cash today. Oh, wait. I do. Cash in your pocket. This is cash flow. This is what financial managers really look at. Can anybody guess the year of this bill? 2013. I get to keep it. Okay. So it's when the cash flows are available to shareholders, and profit maximization, fails to account for risk. If you're failing to account for risk, you may maximize your profit. This company may maximize your profit, but if this is riskier, if this company is a sure thing, like a McDonald's franchise, and this company is like a Checkers franchise, which would you rather own? You want the thing that's less risky. So these are things that you have to think about. Timing and cash flow, riskiness of the asset, and so sometimes grabbing what looks to be the most profitable may not be the best thing for the share price because there's a lot of factors at play. These are the nuances that the financial manager has to deal with. So it's not always straightforward. Let's talk about stakeholders. So these are people who aren't the owners of the company, but they're people who are involved in the company and have a stake in the company, such as employees, customers, suppliers, creditors, and owners as well. As they can be considered stakeholders as well. But we're thinking about people other than owners, and these are people that depend on your business as well. Suppliers depend on your business for them to make money because their business is selling to you. Employees depend on the business for their paychecks and their livelihood. So anybody who has a direct economic link to the business is going to take a financial loss if the business closed or if the business shrank. So a firm has to keep their stakeholders in mind because they want to avoid making them upset. They want to avoid doing anything that's going to hurt them. Not that they put them first in all cases. Really, the owners have to be put first, but the stakeholders have to be taken care of as well. And this is one of the responsibilities of the financial manager to make decisions that are not going to hurt, say, the customers. So if you make a product, you don't want it to explode and kill your customer, like Ford and GM did. Ford made a car, a Pinto, that when it was rear impacted, it exploded. And GM made a truck when it was side impacted, or maybe it was Ford, I don't know, one of those companies. When it was side impacted, it exploded, and they knew about it. And they said, well, okay, let's do the numbers. How many cars are likely to explode, and how much are we going to pay out in lawsuits because of this? Okay, that's one number. And how much to recall these vehicles and fix them? Okay, that's another number. Which number is bigger? The recall is bigger? Okay, well, let's just let a few people die then, because that maximizes our profits. They really made that decision that way. That's horrible, right? Okay. So that ties me into business ethics. So now more than ever we have to be ethical. There was a time called the 80s and the 90s and the 2000s when we didn't have to be so ethical. But now we have to be ethical because all eyes are on companies, the transparencies, government regulations. Customers are more knowledgeable, and the planet's getting smaller. Pollution's a bigger concern, global warming. All these things, we're just more knowledgeable of what can happen to us. E. coli in our Chipotle. This is all stuff that, businesses have to have strong ethics to avoid detrimental decisions to society. Now, they shouldn't do things that's going to create harm. So in early 2000s, 2003, a company like Enron and Global Crossing, they made bad financial creative decisions that made their companies look better than they were, and basically were fooling or lying to shareholders, and those companies created a mini stock market collapse in 2003. So misleading financial forecasts, misleading profits, fraud, which is, lying, cheating, insider trading, excessive compensation, options backdating. Does anybody know what that is? Options backdating? Something that they did at Apple. Basically, yeah, they want to take the options and they want to take a price in history that was lower price and backdate to the lower price so they're instantly profitable, thereby giving Steve Jobs more millions and millions of dollars instantly, which he claims he didn't know anything about, which he got away with. But Apple was called out on that. Bribery, kickbacks. Anybody kickbacks are big in a lot of foreign countries. They're not so much big here, but in some foreign countries, you get pulled over, you give the officer some money, they let you go. You go to motor vehicles, you want to get your license, or you want to renew your registration, you grease the wheels a little bit, things happen faster. So, but kickbacks can happen in American companies. It could be a situation like this. I worked at a company where the maintenance manager who set up the landscaping company decided to, take a kickback, which was season tickets at Shea Stadium as a kickback, or got his lawn cut for free. Yes.
I got a question about the Enron. The people that did the books for them, I don't know, Johnson, like the guy's name.
I think it was Arthur Anderson, maybe.
Yeah. He's still like has a CPA and he still does books for other
Oh,
companies. Like,
yeah.
Like how is that even possible?
Well, when you're in finance, if you mess up, you don't really go to jail. Maybe get some fines or slapped on the wrist, but that's one of the problems they're trying to address, is that when you do these financial crimes, unless you're Martha Stewart, then you definitely go into prison. But everybody else, they kind of just slap you on the wrist and say, don't do it again. And they don't really have, that's one of the problems, that they don't really reinforce these, a lot of these laws with punitive damages to the people who are breaking them. Just like this whole financial Great Recession, there's one person in jail for this. And they basically stole billions of dollars from the world in these collapsed financial products, but no one yet went to jail or punished or got their license revoked, or it's just, rich getting richer, 1%.
Yeah, and how shorted the market, housing market? How were they not?
Oh, you can, if you see it and short the market, that's perfectly legal. You didn't create the problem. You didn't, if you can't be held accountable for shorting something unless you had unfair insider trading knowledge. So if you just saw, what was publicly available and you figured out that subprime mortgages were a pile of crap and you shorted them, that's perfectly legal, and they're not going to be any financial problem, regulatory or legal problems with that. It's the people who were lending mortgages to people who couldn't afford them that should really be held accountable. We're going to get to that in a minute, though. So the reason you need to be ethical is that bad things tend to come back to you. So, and companies don't need negative publicity. Companies don't need to have unethical things being brought to light, shining a spotlight on the company's actions. So that's why, if it's nothing more than just making sure that it's in the company's best interest to be ethical, rather than just in your own personal best interest, which it is both. This is a framework here of considering ethics, and this guy, Robert Cook, came up with some questions to think about as far as, is it ethical? Does the action, some questions you ask yourself, does this action I'm taking in a corporate setting, is it going to single out an individual person or group? Is it going to affect the morals? Is the action going to affect the morals of a group or the legal rights of any individual or group? Does the action conform to accepted moral standards? Is there alternative courses of action that are less likely to cause harm or potential harm that you could take? So these are just things that in theory, you should think about before you make any big decisions at a corporate level, even at a private, personal level. And if you are ethical and you have a high ethical standard at your company and in your employees, then you reduce litigation and judgment costs against your company. You maintain a positive corporate image. You build shareholder confidence. You gain the loyalty and respect of stakeholders. VW stock is decimated based on what they did. You know, they didn't kill anybody. They didn't even hurt anybody. They hurt the environment. They lied to the people who bought those cars. They went against government regulations. But their company that had a really top image is now, you know, we'll put them down with a Kia. Maybe even below a Kia. Right? Isn't that the car company that we see with the lower quality? Not no quality. If you're driving a Kia, I understand. But I'm just saying that it's a Kia, not a BMW. Okay, let's be real. It's a Honda, not a Mercedes. So car companies have different categories of perceived quality. Now, Volkswagen, they've gone down a few rungs. Yes. You going to say something back there? No.
They own Audi and...
Audi, yeah. It's a nice car.
What's the other one? They have another company.
Yeah, I'm not sure. Google Glass. This is a Google product. Now, Google is a very ethical company. They don't want to do any evil. They actually state in their owner's manual to do no evil, don't be evil. But they created these Google Glasses that had a lot of controversy around them. Well, first of all, the Google Glasses kind of failed because they're not cool. You don't go around wearing Google Glasses. It's just you get punched in the face. But they did have some problems because you can, like, record on them. So what if you're in the locker room with your Google Glasses on? There's a privacy issues. What if someone's at the ATM and you're recording them, putting in their PIN number or, you know. So this is something that, even though it's a very ethical company, sometimes they do create a product that can be used in unethical ways. But is that their fault? Okay. So the managerial finance function really depends on the size of the firm. The bigger the firm, the more functions, the more positions. And smaller firms, you're going to be a jack of all trades in finance. And they may not even have a finance person or a finance department. It may be the accounting manager doing a lot of financial tasks. All right, moving forward. Here's the corporate organization again, just to show it again, I guess. Now there's a relationship between finance and economics. So in this day and age, what's happening in finance and economics? In economics, there's a slowing of the Chinese economy. There's a supply imbalance of oil. Does that affect finance people and companies? It does, because it affects the cost of energy. It affects the demand of products. It affects the global perception of the economy. It affects the stock market. So economics is closely layered and tied into the framework of finance, because finance is about charting a path forward for a company to make more money. And one of the things you have to do is chart, you know, the economic growth of your business, your industry, the world. So forecasting becomes intimate with economic forecasts, and that's all folded into finance. So, and there's this marginal cost-benefit analysis that we're going to be doing in class in a little bit, and this sort of looks at, you know, what's the cost versus the benefits. So this is analysis we do that's based in a classical economic analysis. So here is an example that, do I have that example here? Yes, I do have an example. We're going to be going over, this is one of the spreadsheet examples we're going to be going over today, but basically, to run through it, you want to buy a new computer. So the benefit of buying this new computer is going to generate $10,000 of new money for your company, and the old computer is going to be set to generate $3,000. So if I buy the new computer, I can make $10,000. And if I use my old computer, I can only make $3,000. So the net benefit of buying the new computer is $7,000. But there's a cost of the new computer of $8,000, and I can sell the old computer at $2,000, so the marginal added cost would be $6,000. So sort of like when you buy a new car and you turn in your old car, it gives you some money towards your new car. So I can make $7,000 additional dollars by getting in this new machine, and it's only going to cost me an additional $6,000 to get the machine, so the net benefit's $1,000. So we're just looking at the benefits additional benefits minus the additional costs. And that's the relationship, that marginal cost benefit analysis. Okay, let's talk about the relationship of finance to accounting. So we have finance, and like I explained before, finance is making decisions based on the accounting activities. So accounting has to carry out all the day-to-day work of managing all the numbers and putting them to the right buckets to develop the financial statements and ratios. So in a large company, you're going to have financial analysts that are going to compile analysis from the accounting information. In small companies, you may not have enough money to have a financial analyst, so sometimes the accounting manager will take on the dual role. So accountants generally use an accrual method while finance focuses on cash flows. So accountants are focused on the accounting principles, and they're looking to calculate an accrual method style of profits, while finance people focus on cash flow. They want to focus on the money going into the pocket, because net profits is not cash going into your profit. We'll explain that later. Okay, so whether a firm earns a profit or experiences a loss, it must have significant cash flow to keep the business going. So even companies that have a loss still have to have a positive cash flow, and you can do that by borrowing money. Just like you're going to school, you have a loss right now as far as you have more expenses than money coming in. But you're borrowing money somehow, your parents, student loans, scholarships of some sort, to keep your business, your business is going to school, keep that running, even though you're operating at a loss. But when you graduate, you're going to make money, you're going to be work, you're going to be paid back that debt, you're going to be operating at a profit level. So if we look at this following example, if sales are $100,000 and costs are $80,000, so say you sold one yacht for $100,000, but you haven't collected the money from it. Just because you could have sales but not collect the money. So basically someone says, I'm going to buy that, and you give it to them, but you don't get money right away because it's on account, but it costs you $80,000 to buy that boat. So if we look at it this way, this is the accounting view where we sold it for $100,000, their cost for $80,000, so the net profits are $20,000. But there's no cash in our pocket because they haven't paid it for us yet because they're on 60-day credit. The financial view is going to see that there's no cash flow, but we paid $80,000 for the boat, so we're actually cash flow is negative at $80,000. And that's more realistic to where the company's bank account position is. So accountants are just looking at profits. Financial people are keeping it real and looking at where the cash is. All right. Now, in your own personal life, you may have your own inflow and outflow of cash. So in this particular example, you have your net pay received if you're working for the month, and then you have your rent, your car payment, your utilities, your groceries, your clothing, your dining out, your gasoline, your Netflix account, your Hulu account, your cable account. Am I missing any other accounts? Monthly bills. All right, and then maybe you have some interest income and miscellaneous expenses. So you look at your total inflow of cash is $4,600, your outflow is $4,800. You have a net cash outflow of $215, which is bad. So that's an unbalanced budget, which means you're going to have to dip into your savings or borrow some money to balance that. But that'd be like in a personal side that if you look at your money and you create a budget for yourself, or just looking at your cash inflows and outflows, you get a better idea where your money's going. This is something, it's hard for people to do this, to write down everything you spend, to keep track of every little thing you spend in like a diary. And then you really get to see that you're spending a lot more than you think. Every pack of gum, every pack of cigarettes, every soda, movie tickets, popcorn.
Starbucks.
Oh yeah, Starbucks. I broke that habit. I haven't missed a coffee now. Okay, so finance and accounting differ in respect to decision making. So the decision making in accounting is more about the profits, and in finance more about the actual collection and managing of cash. So, and it's also in finance we look at risk and return in our decisions. Where in accounting we're not looking at that; we're just doing the accounting work. Finance we're more concerned about the risks and returns of our decisions that we're making. Okay. So in making investment decisions, we have current assets and fixed assets. So investments in companies would be their assets. Buying equipment, buying plants, holding accounts receivable. And the making financial decisions is more about your liabilities. What long-term debt you're going to acquire, what short-term debt you're going to acquire. And in the simulation, you're going to be doing both sides of these in the simulation. You'll be creating short-term assets and buying long-term fixed assets, and you'll be borrowing money in short and long-term positions. Okay. So corporate governance, when we say corporate governance, we're talking about the rules, the process, the law which companies operate and companies are controlled and they're regulated. So governance of corporations is how they operate. What are their rules they have to work by, the laws, the regulations, how they're controlled, the rights and responsibilities of the corporations, the participants, and the shareholders. This is all part of the corporate governance. It's just really a word to express how a company runs, fitting into the rules of the legal and societal frameworks for the decision making. Now, there are two types of investors, individual versus institutional investors. So individual investors are someone who owns usually a relatively small amount of ownership of shares in a company or in a stock, 100 shares of Apple as a personal investment. And there's institutional investors that are professional investors like mutual fund managers, banks, insurance companies, pension funds that are paid to manage large groups of investments for others. So unlike the individual investors, these institutional investors get involved with the companies. So they're big enough and they own enough stock to elect people to the board of directors and put pressure and influence on companies and challenge their management decisions. Governments also get involved in corporate regulation, government regulation, and they pass laws about what companies can and can't do as far as how they interact with the public, the environment, and other companies. And these laws can hopefully, they're supposed to land people in jail for any type of corporate misconduct. Because of that corporate misconduct in the early 2000s, we got the Sarbanes-Oxley Act, which was meant, let me just break it down to you without reading all these bullet points. In the late 90s, we had this stock bubble in internet stocks, and we had all these companies doing whatever they could to make their company look more profitable, so they could get the stockholders to buy more stock and increase stock prices. Now, why were they so desperate to do anything possible to raise the share price? It's because all these workers and owners, these top-level managers in companies, had a lot of stock options and had a lot of personal investments riding on the stock of their company. So they were doing what was in their best interests, and that included fraud, lying, and cheating to make their company seem much better than it was, so the stock price would go up and they could make more money. Now, they did it in such a complex way, they convinced themselves it was kind of legal. It was kind of okay what they were doing, creating offshore accounts, creating offshore holding companies to move bad debt and bad things onto, so the main set of books looked good, and they did all these things that eventually everything got discovered, and a bunch of companies blew up and created, extended the recession and extended the stock market bubble bursting. And the government got involved, and they said, listen, this is total crap what you guys did. We're going to have to put more levels of regulation, oversight on your financial statements and transparencies of your company to make sure that you don't screw up like this. Now, how this happened was the auditors were supposed to work for the shareholders to review the accounting books to make sure that the accounting was correct and say they approved that the accounting is correct and the company's true. The problem was the auditors were in business with the companies they were auditing, so they weren't allowed to say the company was doing something wrong because they'd lose that business. So there was a conflict of interest. And Sarbanes-Oxley broke up and made it illegal to have a conflict of interest between your auditors and your business, so they can no longer be partners in some businesses and also work together. It just was the fox watching a hen house, basically. So the Sarbanes-Oxley was meant to reestablish that structure of audits being more true and fairly regulated to keep these companies more honest. And this is sort of that principal-agency relationship. We have these agency problems and agency costs. And basically what it means is that when you're a manager and you don't do what's right for the business, you do what's right for yourself. So as a manager, instead of hiring the best possible candidate to work in the company, you hire your slow brother-in-law. Rather than, pick the best supplier to supply your company with the raw materials you need, you pick a supplier that of a company your wife's father owns. So you're at a higher price. You're picking the oil company to fill up the heating oil of your company because they're going to fill up your tank at home for free.
With the auditors, they couldn't have stockholders and companies that they were auditing.
Not anymore. They got to break that up. They have to be separate, and because they can't be swayed. That was the problem. They had so much, they weren't allowed. They were told not to. And these auditing companies also had They were so big. They had other divisions that were stock analysts, and everything was just so tied together that their hands were tied. And now they broke up the auditing companies to be more independent, and they couldn't run multiple businesses through the auditing company. They made them pure. But that was definitely an agency problem. So the agency problem is when you're working for the company and you're not doing the right thing, but you're doing something that benefits you. And that can cost the company a lot of money. So corporate boards, institutional investments, government regulations, corporate governance have to be strengthened to make companies do the right thing, so to say. But now management compensation has gotten out of control. And this is one of the reasons that sometimes managers may do the wrong thing to benefit their compensation, but not necessarily benefit the company. And that might be something like doing something in the short term to increase sales and profits that might be bad for the long term, because in the short term they're going to get more bonuses for it. So the compensation needs to be created in a way that motivates the manager to be a better manager for the company. So if you had a compensation that was based more on long-term goals than short-term goals, then the manager can do what's right for the company in the longer term, not the shorter term. So they need to structure this compensation in a way that motivates managers to increase shareholders' wealth, but do it in a way that's honest and sustainable and long-term. So they could do incentive plans where they get compensation based on meeting certain goals. They can get grants of stock. And then when they own stock in the company, they have incentive for the company to do even better. And they can get performance plans based on growth in the earnings per share. That can be tied to cash bonuses and other types of compensation. And sometimes these compensation plans are under review because they're too generous. And you hear about the CEOs making so much, millions and millions of dollars to run these companies, while the average line worker is making a minimum wage. It just doesn't seem fair how disproportional they are. And here is an example of a number of executives making a lot of money. Larry Ellison making $96 million while his stock goes down 22%. The Mark Parker for Nike making $35 million, but his stock actually went up 30% and went up another like 20% this year. So maybe he's earned that money. But regardless, it's nice to be CEO of a large company because you get extensive wage packages. Okay, I'm going to skip that slide. Okay, this is learning goals we talked about before. Okay, so now we're going to move into more of the spreadsheet work, and there is additional problems on, of course, the homework manager, and we have the group exercises with the simulation, but right now we're going to do some critical thinking, and we're going to work on a problem. And basically what this is I'm going to show you how to solve the spreadsheet. But you're going to do it by hand. So everybody have a handout? Did we reach everybody? Okay. Just take a second to read this while I open up the spreadsheet. We're going to work on problem 1 together, and then you're going to try problem 2. Okay. So problem 1 here says, assume that Montesano Corporation is considering renovation and or replacement of older equipment. Its objective is to improve efficiency in operations, the speed and reduction of defects. The company's finance department has compiled some data that will allow us to do a marginal cost benefit analysis. So for the proposed equipment replacement, the cash, right here, the cash outlay for the new equipment will be $600,000. This is what the new equipment is going to cost us. And the book value of the old equipment and its potential selling price is $250,000. That means if we buy the new equipment, we're free to sell the old equipment on eBay, I guess, and get some money back. Now, the benefits of the new equipment is going to be $900,000. And the benefits of the old equipment for, like, say, the next year is going to be $300,000. Okay, so we want to create a spreadsheet and conduct a marginal cost benefit analysis for Montesano Corporation to determine the following. A, the marginal added benefits. B, the marginal added cost, and C, the net benefits. So you remember this from that slide in the PowerPoint? So first box, and you can kind of fill this out as we go, the net benefits of the new equipment. So I'm going to hit plus, and I'm going to select the benefits of the new equipment. And then less the benefits of the old equipment. Again, I'm going to hit plus, and I'm going to select this cell. Enter. So the marginal added benefits is going to be taking, I'm going to hit plus again. I'm going to take the 900,000 minus the 300,000. So the marginal net benefit is going to be 600,000. The cost of the new equipment, right here it says the cost is 600,000 for the new equipment. The sale of the old equipment, 250,000. So I'm going to hit that cell, enter. And then the marginal added costs, I'm going to take the 600,000 is costing me and subtract the 250,000 money I get for the old quit business. So it looks like the buying the new equipment is going to generate $600,000 of additional money for my company because it's more effective piece of equipment. Less defects, produces better quality. And then the additional cost of buying this new equipment is only going to be $350,000 because I have the trade-in of the old equipment. So to find the net benefit, I'm just subtracting 1, subtract 2. Boom, $250,000. Okay, so that spreadsheet wasn't hard to do, right? Now, if you go lower on the spreadsheet, you see problem 2. This is what you're going to do by hand right now. This is a very, it's only one-sided? That's the original copy. Oh, okay. Well, you could kind of just write next to it. So this is an easy assignment in class, but they get harder as the class progresses. But this is sort of how I'm going to work it. I'm going to go to the spreadsheets that you have. This is your spreadsheet 1 assignment, and I'm going to show you how to complete it in class. So you go home, it's very easy to do the homework. Now, if you skip class, you're going to spend more time trying to do the homework, so you're sort of not really saving much time by not coming to class. So that's how I'm trying to make class valuable for you to be here. Now, when you do the spreadsheet, I don't want to see you typing the numbers in the cells. I want to see you connecting the cells together by hitting plus or like I did up here. If you look in the cell, you'll see a plus and it refers to the cell I'm pulling it from. And then here I'm creating a formula, 16 minus 17. I'm not just typing the numbers in. So wherever possible, I want to see that you're creating formulas, not just doing it in the calculator and entering them in the spreadsheet. Yes?
Plus the same thing as equal sign?
Yes, plus and equal sign, the same thing. Okay, so the answer for problem 2 is the net marginal added benefits are $725,000. The marginal added costs are $550,000. So the net benefit is $175,000. So this would be a yes. We should buy this piece of equipment. Okay, so now when you look in the spreadsheet, you're going to see that there are these additional tabs at the bottom of spreadsheets. Because spreadsheets aren't just one page. They're like a book. There are many pages. So, and I always find it amazing, a lot of people don't know this, but there are multiple, some spreadsheets do have multiple tabs. So if I go to tab 2, here's tab 2, isn't it beautiful? I have some color in here. And in tab 2, we are going to, if you start the next handout, everybody have them in this row? All good? This side's all good? In the middle, you're all good with handouts? How about, you're good down there? All right. Okay. All right, so for this spreadsheet, there are 4 problems broken up by this black cross. So in problem 1, products shipped and billed, 500,000. Collections and net credits, net return credits. So that means the money collected less any credits. You know, a credit is when you go back to return something in the store, you buy something and it's like, I don't want this. Costco's great for this. You know, laser hair removal system, I don't want this. Vacuum cleaner, I don't want this. Bananas, I didn't buy this. Well, we didn't sell this either, but I'm returning it, so you gotta, okay, we'll take it back. We didn't sell it, but that's how nice they are. Okay. And then cost of goods sold. That's the material cost of the product you're selling. It's just the labor and the materials. Okay. So the accounting view, we're going to look at in the accounting view, what we're going to do is we're going to take, accountants want to take the product shipped and billed, and they want to subtract, they want to subtract, what's happening? I have having a spreadsheet meltdown here. They want to subtract the cost of goods sold, and this is what they figure. The accountants would figure the profits are take the revenues minus I like how the minus is in red. You can't see that too well. And we get what we say the accounting view is $150,000 in net profits. But the cash basis, the financial view, we're going to look at the cash flow, which is basically the money collected, not the sales, but the money actually collected, less the cost of goods sold. So in this view, we see that we collected $325,000, but our cost of $350,000, we have a negative $25,000 cash flow. Meaning that finance people need to know this because we need to borrow this money to bridge the gap between the time of the sales to the time of the collection. So eventually, hopefully, we get all $500,000. We do show this $150,000 net profit, but right now we have a $25,000 loss because we haven't collected the money yet. They haven't paid us fully. Okay, so that's problem one. All you have to do tonight is problem two, the next problem. See if you can do that by yourself. You can if you want to use. If you want to complete, and that's another thing you can do. If you don't want to work on the handouts, you can bring your PC, download the spreadsheet, and do the spreadsheet writing class, and have the homework done while you're in class as well, like you're doing. And that's perfectly fine, as long as you're getting the work done and you understand what's happening. But not everybody can bring a PC, so hence the handouts. And again, this is just reinforcing what's in Chapter 1, accounting view versus financial view, which you're likely to see in the homework, and then also likely to see in the test. Yes?
When are your homeworks typically due? Are they due like at the beginning of the next class, or like?
I don't know. They're all different times, so keep a calendar. I think I try to standardize it on, one particular night. I'm not sure what that is, but some homeworks, it's not like you're going to have a homework due every week. Sometimes it might be a 2-week gap. For example, the first homework isn't due for a while because of this add-drop period. So I don't want to have someone add the class 2 weeks into the class and then the homeworks are closed already. So you're getting a little bit extra time to do the earlier homeworks, and you'll have a little less time to do the later homeworks once the add-drop period's over.
And there's due dates on Blackboard.
Yeah. Everything has due dates, yes.
Well, I mean, like, there's due dates for this on Blackboard and due dates for the other homework on the
Right, they're in two separate. Yeah, so you have to go to the homework manager to see the due dates there, and then the Blackboard to see the due dates here. So probably if you want to be a good time manager, just like take a calendar and then kind of lay them all out, But nothing's due right away because add drop.
Thanks for the question.
Problem, again, once I have these formulas set up, I can just kind of move them over rather than redoing them. And you should get a net profit of $450 and a cash flow of $200,000. Was anybody able to duplicate that? Okay. Now, yes. Oh, you're just saying yes, you did duplicate it. Okay. Also, once the spreadsheets assignments are due and submitted, under documents, I will open up a key. So that way you can go in, and if you weren't quite sure how it was done, you can actually work backwards with my key. So you have 3 opportunities. 1, do it in class is 1 opportunity. Again, when you do it at home for the homework, it's 3rd opportunity. And 3, reviewing the answer keys once they open up after the due dates on the assignment. Okay. Moving to, if you flip that over, we have a cash flow problem. Okay. So here, again, it's kind of straight from the textbook. We're just looking at cash inflow. So net pay would be considered inflow, but rent is a cash outflow, right? Because you pay rent. Anybody here paying rent? It's terrible. Now, textbooks, I changed this up a little bit. Textbooks, car insurance, utilities, Netflix, food, gas, student loan. Is a student loan a cash inflow or outflow? Inflow, you're getting money. How about a loan from mom? Is it a cash outflow or inflow? Right, you got it. So all these here are going to be outflows of cash, and here is going to be an inflow. So then what we want to do is we don't want to find a total for each of these. So I'm going to hit this little, see this little E here, sum key. I'm going to hit that, and I'm going to extend, and pull this corner up and extend it, sum that column, copy that over. All right. So then the net difference is going to be your inflows minus your outflows. So we have a net of $830, which just means this month is good. Okay. So again, and remember, this is chapter 1, so it's easy. Wait till we get to chapter 3. You can preview, see some of these spreadsheets, you'll know what you're in for. So that way you have a better idea whether to add, drop this class maybe. This guy's left-handed right here. Just like Obama. And me, I'm also left-handed. Anybody else left-handed? No? Okay, 3 people. Again, on the spreadsheet, once you kind of create your formulas on one problem when you're doing the spreadsheet, you can just copy that, move to the next problem, and paste that. I'll never know. So the net is a loss of a net cash outflow of $30. Does that jive with anybody? Okay. All right. So